This is the English version of the analysis of the American market. We start with the Commodity Research Bureau Index, the Commodities Index. As we can see, we failed to cross in a consolidated way the $15 resistance. That is a consequence of the correction of the dollar index against the euro, or if you prefer, the recovery of the euro against the dollar. We have an 82% probability of the new low. It's pretty high, but the target in this case would be the $10 support. The C equals A target is $17.10. So technically speaking, we could see a continuation of the commodities up to this level. We have to take into account this pivot over here of November 4th. It's pretty important, this level in 1789, but up at 1967 we still be in a counter-trend movement, so we have to be extra careful if we are playing a commodities trade. So the only possibility to go at least at the level C equals A is if we see a recovery of the dollar against the euro in the next few days. As we can see in the dollar index that we have over here, the target of C equals A of this counter-trend movement was achieved in Thursday at 83.21. It almost go there, and as we can see, if we count the amount of bars over here with the reference movement over here, the proportion, the symmetry of the waves is correct, and we have a 62% probability of a new high, but with a strong resistance in the $90 level, so we have to be extra careful. But if we can see that 83.21 of, if all of you prefer C equals A, was the full correction of this movement, the up movement of the dollar could trigger a continuation of the commodities market and the stock market. So we have to wait a couple of days, I say up until Wednesday, to see if this low over here is the definitive low or not, because in that case, we if it fails to support on an incremental sell pressure, we could end up going over here 80.34, and this is the level when this correction becomes an downwards impulse. So up until now we have C equals A and a 62% probability of a new high. So the logic says that if we manage to go upside 85 again, the 62% probability of a new high will be triggered, and we have to achieve the $90 mark. In the Dow Jones market, we see that the C equals A objective was 95.12, but we have a strong resistance in the 9,000 level that it was expected to be, since it's a strong psychological level. So we have to wait to see if this movement over here is actually a counter-trend movement of a bigger C wave, so to speak. We have a 55% probability of a new low, but this new low will imply a forced breakdown of the support of 8,000, so it's pretty difficult to be. But either way, we have to see that if we manage to stay above 81.27 in the DIA, we have to see a run for the resistance of 9,512. So we have to be extra careful in the next few days, since I'm assuming the movements in all sectors, commodities, stocks, and bonds, will be triggered exclusively by the behavior of the US dollar index. If we can see the and X, the 10-year dollars yield, we see it's extremely low, with a 75% probability of a new low at the level of 25 basis points. Is extremely low. In case of a continuation of a rally over from the 25 support, we have a primary target in 29 and a secondary target in 31. But either way, these levels of the 10-year dollars 10-year bonds yield implies a bonds bubble. This isn't a speculative bubble, but a protective bubble. The people is trying to protect the amount of dollars they have, so we have to be extra careful. I wouldn't be buying bonds right at this time, but either way, I don't expect this bubble to explode anytime soon, since it's a protective bubble, and the only reason that we could see to explosion of this bubble is that the market conditions will change extremely rapid, I mean an economic recovery of major proportion that is difficult to see. So this bubble of in bonds will continue. As if we see the weekly chart, we can expect to have inclusive continuation at the moment. Even in semi-log scale, we can see that this movement over here is a wave A, this is a wave B, and this is a wave C that could continue even beyond the 25 support. So we have to be extra careful on that, but I wouldn't be buying bonds anytime soon, since I think a zero yield for a treasury is a clear sign of a bubble, and I wouldn't be buying bonds in that situation.